Warren Buffett turned $9,800 into $150.2 billion, making him the 10th richest person in the world. His secret isn't luck or risky bets, it's a consistent strategy built on patience, discipline, and timeless principles. Today, I'm breaking down the exact investment strategies Buffett used to build extraordinary wealth. By the end of this video, you'll know how to apply these same principles to your own investments. Buffett's first rule is deceptively simple. Never invest in a business you don't understand. He calls this staying within your circle of competence, and it's guided every major decision of his career. Buffett once said, "Risk comes from not knowing what you're doing." This is why he avoided tech stocks during the late 1990s dot-com bubble, when everyone else was going crazy buying them. Here's a perfect example. During the tech boom, investors begged Buffett to buy internet stocks. While companies like Pets.com and Webvan were soaring, Buffett stuck with businesses he understood like Coca-Cola and insurance companies. When the bubble burst in 2000, those flashy tech companies lost 78% of their value, while Buffett's portfolio stayed strong. "I don't look to jump over 7-foot bars," Buffett explained. "I look around for 1-foot bars that I can step over." For everyday investors, this means sticking to industries and businesses you genuinely understand. Don't invest in cryptocurrency, biotech, or complex derivatives if you can't explain how they make money in simple terms. If you work in retail, you understand consumer behavior, invest there. If you understand banking, invest in banks you trust. Buffett's second principle is buying wonderful companies at fair prices, not fair companies at wonderful prices. Early in his career, he followed Benjamin Graham's strict value investing kind for statistically cheap companies regardless of quality. But under Charlie Munger's influence, he evolved toward prioritizing business quality over seeming bargains. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buffett wrote in his 1989 shareholder letter. His investments in Coca-Cola, American Express, and Apple exemplified this approach perfectly. When Buffett invested $1 billion in Coca-Cola, 1988 Wall Street analysts said he was overpaying. The stock wasn't trading at a bargain price by traditional metrics. But Buffett saw something others missed. An unbeatable global brand, consistent profit, and a product people would buy forever. Today, that $1 billion investment is worth over $25 billion. And Berkshire collects over $700 million in Coca-Cola dividends annually. "Time is the friend of the wonderful business, the enemy of the mediocre," Buffett explained at a shareholder meeting. A truly exceptional business at a reasonable price will outperform a mediocre business at a cheap price over time. Focus on companies with proven track records, strong balance sheets, and competitive advantages, what Buffett calls economic moats. Buffett's third strategy is thinking long-term and letting compound interest work its magic. "Our favorite holding period is forever," Buffett famously wrote in his 1988 shareholder letter. This long-term perspective stands in stark contrast to today's meme stock culture and day trading apps. "Someone sitting in the shade today because someone planted a tree a long time ago," Buffett once said, perfectly capturing the power of patient investing. Consider his investment in Coca-Cola again, which he's held since 1988, that's 37 years. While the stock has experienced numerous short-term fluctuations and market crashes, Berkshire's patience has been rewarded with dividends and appreciation far exceeding what active trading would have produced. If you'd bought just $10,000 of Berkshire Hathaway stock in 1965 when Buffett took control, it would be worth over $364 million today. That's the power of compound interest over decades. According to recent data, the S&P 500 delivered 26.29% in 2023, 25.02% in 2024, and 14.47% so far in 2025. But those returns only work if you stay invested through the ups and downs. The stock market is a device for transferring money from the impatient to the patient. Buffett has said repeatedly, "Time in the market beats time in the market every single time." Buffett's fourth principle is being greedy when others are fearful, and fearful when others are greedy. Be fearful when others are greedy, and greedy when others are fearful. He wrote in his 2004 shareholder letter, "When markets tumble and fear takes over, most investors panic and sell at the worst possible time." Buffett does the opposite. He buys high-quality assets at discounted prices during times of maximum fear. Let me give you a powerful example from the 2008 financial crisis. When Lehman Brothers collapsed and the stock market was crashing, everyone was terrified and selling everything. Buffett invested $5 billion in Goldman Sachs on September 23, 2008, when people thought the entire financial system might collapse. "I like buying on sale," Buffett told CNBC at the time, comparing stock purchases to buying stocks at a discount. That $5 billion Goldman Sachs investment alone earned Berkshire over $3 billion in profit. In October 2008, when the S&P 500 hit rock bottom, Buffett wrote an op-ed titled by American, "I am," urging investors to buy stocks while everyone else was panicking. "Bad news is an investor's best friend," Buffett explained. "It lets you buy a slice of America's future at a markdown price." His recent moves highlight this contrarian approach perfectly. In 2025, he trimmed his Apple position by 30%, taking profits after massive gains, but he invested $1.6 billion in United Health Group, which was down 46% year-to-date due to regulatory scrutiny and negative headlines. While everyone else was avoiding it, Buffett saw value in a strong company facing temporary problems. Buffett's fifth strategy is championing S&P 500 index funds for everyday investors. Consistently buy an S&P Goheku low-cost index fund, Buffett said at a Berkshire meeting. Keep buying it through thick and thin, and especially through thin. This might surprise people. Why would one of history's greatest stock pickers recommend index funds instead of picking individual stocks? The answer is simple. Most people don't have the time, knowledge, or discipline to beat the market consistently. Even professional fund managers with entire research teams struggle to outperform the S&P 500 over long periods. In 2007, Buffett made a famous $1 million bet that an S&P 500 index fund would beat a collection of hedge funds over 10 years. Buffett won decisively. His index fund returned 125.8%, while the hedge funds averaged just 36%. A low-cost index fund is the most sensible equity investment for the great majority of investors. Buffett wrote in his 2013 letter. His reasoning is simple. The S&P 500 mirrors the growth of the American economy. It's composed of world-class companies like Apple, Microsoft, and JP Morgan Chase that consistently reinvest profits and drive long-term wealth creation. For first-time investors, buying an S&P 500 ETF through Vanguard, Fidelity, or Schwab provides instant diversification across hundreds of top companies. No market timing, no stock picking, no stress. If you would like spending 6 to 8 hours per week working on investments, do it, Buffett said. If you don't, then dollar cost average into index funds. Buffett's sixth principle is keeping cash reserves and staying patient for opportunities. Right now, in 2025, Berkshire Hathaway is sitting on a record $334.2 billion in cash and short-term treasuries. Many investors criticize this, saying Buffett should put that money to work immediately. But Buffett understands that having cash when everyone else is desperate gives you incredible power. Cash combined with courage in a time of crisis is priceless, Buffett has said. Think of cash as dry powder waiting for the right opportunity. During the 2008 crisis, Buffett had billions ready to deploy when great companies needed capital desperately. He struck deals with Goldman Sachs, General Electric, and Bank of America that ordinary investors couldn't access simply because he had cash available. This doesn't mean you should keep all your money in cash waiting for crashes, but it does mean maintaining an emergency fund and having some investable cash ready for opportunities. The stock market is designed to transfer money from the active to the patient. Buffett reminds us, when a stock you've been watching drops 30% due to temporary bad news, that's when having cash matters. The lesson for regular investors is simple. Don't invest every last dollar immediately. Keep 3 to 6 months of expenses in an emergency fund and maybe 5 to 10% of your investment portfolio in cash. You only have to do a very few things right in your life, so long as you don't do too many things wrong, Buffett explained. Patience, please. Buffett's seventh principle is avoiding debt and leverage like the plague. I've seen more people fail because of liquor and leverage being borrowed money, Buffett said at a shareholder meeting. While hedge funds and professional traders use massive leverage to amplify returns, Buffett has built his fortune using little to no personal debt. Even Berkshire Hathaway maintains an extremely conservative capital structure. Here's a powerful example. In 1987, Buffett watched as portfolio insurance and leverage destroyed investors during Black Monday when markets crashed 22.6% in a single day. Investors who borrowed money to buy stocks got wiped out completely when they faced margin calls and forced selling. Meanwhile, Buffett, who uses no leverage, simply held his positions and bought more stocks at lower prices. When leverage works, it magnifies your gains, Buffett explained. But it's addictive and deadly once having profited from its wonders. Very few people retreat to more conservative practices. In 1998, long-term capital management, run by Nobel Prize-winning economists and staffed with geniuses, collapsed because of leverage despite their brilliant analysis. For everyday investors, this means avoiding margin loans, options without proper education, and definitely avoiding borrowing money to invest in stocks or crypto. If you're even a slightly above average investor who spends less than they earn, over a lifetime you cannot help but get very wealthy, Buffett said. You don't need leverage to get rich, you need patience, discipline, and time. Buffett's eighth and final principle is continuous learning and staying humble. Go to bed smarter than when you woke up, Buffett advises. Despite being one of the world's greatest investors, Buffett spends 80% of his day reading annual reports. Financial, newspapers, books, anything that expands his knowledge. He reads approximately 500 pages daily. The best investment you can make is in yourself, Buffett said at Columbia Business School. The more you learn, the more you earn. When asked about his success, Buffett pointed to his library and said knowledge compounds just like interest. He still reads Moody's manuals, annual reports, and financial statements at age 94 because markets evolve and learning never stops. Buffett also admits his mistakes openly and learns from them. He's called his investment in Dexter Shoe Company the worst deal I've ever made, costing Berkshire billions. He's admitted errors in airline investments, newspaper businesses, and energy companies. It's good to learn from your mistakes, Buffett said. It's better to learn from other people's mistakes. The lesson for us is clear. Invest in your financial education before you invest your money. Read books like The Intelligent Investor by Benjamin Graham, which Buffett calls the best book on investing ever written. Follow quality financial sources. Learn accounting basics. And understand business fundamentals before buying your first stock. So there you have it, Warren Buffett's complete investment strategy distilled into 8 timeless principles. Invest in what you understand. Buy quality companies at fair prices. Think long-term. Be contrarian when opportunities arise. Use index funds if you're not willing to do deep research. Keep cash for opportunities. Avoid debt and leverage. And never stop learning. These aren't complicated strategies requiring genius-level intelligence or insider connections. Investing is not a game where the guy with the 160 IQ beats the guy with 130 IQ, Buffett has said. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble in investing. The principles are simple, but following them consistently over decades is what separates average investors from wealthy ones. If this video gave you a clear understanding of Buffett's strategy, hit that like button and subscribe to Finance Flash. Drop a comment with which Buffett principle resonates most with you. Are you going to start investing in S&P 500 index funds? Or do you want to pick individual stocks using his quality first approach? Remember what Buffett said. Someone's sitting in the shade today because someone planted a tree a long time ago. Start planting your financial trees today. I'll catch you in the next one.